more general topic related, just credit risk management that treasury services groups have to do. And I think this general area is where we are probably the most special and most unique. And it's an area that we've worked as a company to build out over the last few years. And that is leveraging all of the data that we have in our system. I mentioned over $1 trillion in volume, 1 million plus originators across dozens of FIs, all shapes and sizes, very geographically diverse. And we track returns. We track why the transaction was returned. We can characterize each originator similar to like a credit bureau file you'd get when you went to Equifax or TransUnion or Experian on the originator, right? That our financial institutions have. And we've used all that data to build some predictive analytics to help. We can basically tell our clients which originators have a very high probability of submitting unauthorized transactions. And then which ones conversely have a virtually zero probability. And that plays into our ability to do that at the originator level. And then we can also do that at the transaction level. We predict at the transaction level which transactions are most likely to be returned as unauthor NSF, and which have a very low likelihood of being returned. And those capabilities, those analytic tools that we've built, leveraging the data in our network, gives just an enormous lift to our financial institutions in terms of how they set limits. You can be more generous with limits for lower risk customers on the debit side in particular, and so let's turn to sort of the general concept of credit risk management and why it's important. I believe, and you guys may disagree, and I'd be interested in your opinion on this, but I believe that the key responsibility for a treasury services group is effective credit risk management for their originators. And they often do this job in conjunction with the credit risk department at the FI as a whole. But the credit risk group, and I've spent a number of years working in these credit oversight areas, they often don't have the expertise of ACH, right? They deal with different lending areas primarily. This is a unique area. So they rely on their treasury services partners very heavily for expertise and how to think about credit risk. But why don't you guys, if you could, maybe talk a little bit about the nature of credit risk management and why it's important for originators?
Yeah, and I think with that credit risk management, earlier we talked a little bit about a holistic overview. So to really understand that credit risk management, you can't just look at one component. You got to be able to look at the relationship as a whole. So, and when you're involving, these credit departments, a lot of times they're looking to see if there are loans, if there are credit cards, if there are other bank accounts, right, that originator might have. So, I feel like that's a big key component. And I think it's kind of getting into a little bit of that originator review process too, of being able to look at it holistically and make those determinations on how that portfolio is performing and how you move forward with managing that credit risk.
Yeah, so a treasury services group, they've got this one dimension of the relationship with a corporate client, right? And that is providing them, it's really, in many ways, a critical one, maybe not the most important, but I can make an argument it is, liquidity to their corporate clients and processing their payments and giving them cash, both outgoing credits or incoming, when they debit an account. In terms of receiving a payment from a consumer or another business. And so they're responsible for this area. But to your point, there's a broader relationship that the FI has. And the reason that they serve corporate clients, business clients, is that they want to make them loans. They want to invest their funds in addition to this liquidity or treasury management. This is a very important area, but there's an aspect within treasury services related to credit risk management, the originator, that's critical in that overall relationship. What I mean by that is that if you have a corporate or business client that's processing payments with you, You want to be able to give them, what we mentioned before, non-pre-funded credit options. You want to be able to send payments out on their behalf, their payroll, their partner payments, their vendor payments. You want them to be able to process those payments without having to have cash in the account that day. That's a valuable service. You can also charge a fee for that, but it's a valuable service for the enterprise because it's more likely to bring that customer into the bank and more like them because they have those features. Alternatively, if you're very restrictive and you require that they pre-fund everything, you're less likely. You need to be more competitive in other areas or you're not going to get their business. You're not going to be able to grow your overall financial institution business. There's a very big picture here. On the debit side, being able to give them credit for payments that they process provides liquidity to their business that makes the financial institution either competitive or not competitive. If you hold everything for 30 days or you make them have a reserve account beyond that, that they can't touch, businesses don't have a lot of extra liquidity. You're hamstringing them. And businesses will go find other financial institutions that can be more liberal, more generous with how they offer these services. So the key component of being able to do those things for your financial institution, for Treasury Services being able to do them for your client, is in understanding the credit risk. Because if you are very generous and say, you don't need to pre-fund anything, we'll send out $800 million of payments across the board and not require you to have money in your account, and you lose that money, then you've made everything not worthwhile for the financial institution. You're going to lose your job, right? If you have $100 million or $200 million, $300 million a month in debits that you process for your clients, and you want to give them access to that credit, that money, without holding a portion of it, to be competitive, you have to understand in both of those areas which originators are high risk and which originators are low risk. That's the nature of credit risk management.
And there's a real interesting opportunity that a lot of financial institutions miss out on. So a lot of financial institutions have blanketed rules to say if you're in this industry or if you're this type of originator, you are therefore high risk and you need to have the types of controls in place that you're mentioning, reserves on your account. But if you were to move to a more data-driven model that looked beyond just what industry you're in, but what type of activity are you actually submitting, you will find that there are plenty of businesses who might fall into those categories who aren't actually high risk based on the activities they're performing. And those are businesses that are getting turned away from other financial institutions that you'll then be able to court. You'll be able to offer them attractive terms that are what they cannot find at other financial institutions that'll still make you profitable.
That's right. And you can charge a fee for this or not, but you still get the benefit of being competitive, which is probably in the big picture more important than any fee income you might generate, and giving liquidity. And I don't believe, I think if I were to say one thing that Affirmative, what we believe we can really impact in this industry in the future is giving our clients, Treasury Services groups, much more powerful tools for understanding credit risk of their originators and managing it much more effectively than they have in the past. And that our mantra, stay compliant, reduce loss, and grow revenue. Let's say you don't have any losses, like you're so conservative, everybody gets pre-funded, or there's a very small number that don't, everybody has a hold period. That's not necessarily the goal. The goal is to manage that risk. Being in banking, if you take no risks in banking, you don't make any money. That's just, nobody believes like you can run a risk-free financial institution. Managing risk is what being in a financial institution is all like. Maybe whether it's deciding who to give a credit card loan to, who to give a home loan to, or who to give credit to when they process their payments through you. This is the area I believe we can leverage our data, and I see a gap. I see a gap in how that data is used by financial institutions to learn from it, to be able to make better decisions about how they manage their clients. And it's really like the tools are there. So there's the credit and debit limits, there's hold periods. We mentioned all these, right? There's reserve accounts. And this is really about being able to apply those tools with the knowledge, a better knowledge of who they need to be applied to. If the financial institution is too generous, too permissive rather, or if they're too restrictive, it's really that Goldilocks analogy, then they're losing compared to another institution that's smarter about how they use their data and can find an originator that they say, hey, you don't need to pre-fund anything with me because you're good. Or we'll give you next day or same day credit for all of your debit transactions. You can have that liquidity. All you need to do is move all of your accounts over to our financial institution. There's a competitive edge that FIs can get by getting much better about this. And I think that's a big blind spot. My opinion, I mean, there's a lot of smart people in this business, and a lot of our clients are in tune with it and getting there. But I think there's a huge, enormous opportunity across the industry to get much better at that. And we've developed some capabilities and some tools with the data to help our clients do that.
And Kim and I were just talking about this yesterday, is that when you do have an originator who is maybe a little bit higher risk, they've had some higher return rates, and you put them on some kind of remediation program, often the decision you're then facing is get those return rates down, or we have to let this customer go. We have to take them off the board. And through things like our scoring, we could say like, well, let's segment them. Here are your high risk customers, but now let's drill in another level. What portion of their transactions are high risk? Because if you can go and have an intelligent conversation with them to say, okay, you're over these certain thresholds that we're uncomfortable with, but it's these business transactions. If it's a third-party processor, maybe it's just one or two originators, or maybe it's just certain types of activities they're performing. And we could say, we value this relationship, we want to keep it, but this is the activity that we see causing a problem and that we need to decrease. You can maintain that relationship. You can keep, the relationship healthy, keep them as a customer. But without this kind of data, like how would you do that? You're just guessing. Yeah. And that's really what we're trying to solve for, is no more guessing. We want to give people the data so they know what to do.
And I really want to see financial institutions stop having to be reactive and get into that proactive mode. And I talk to so many different financial institutions, whether they're our customers or not, and it's really, really interesting because and I'm going to say we because I was in the financial institution too, but we get bogged down with all of the manual reporting, all of the oh my gosh, what happened last month, right? What happened in this previous month? What happened in the previous 60 days? You're very much bogged down with that, trying to put all that together and analyze it. And you don't have the ability to look at the present and the future. Everything is strictly reactive. And when you're wanting to grow your origination program and you're wanting to have effective risk management, you have got to have the tools and resources in place and the automation in place to stop spending so much time on being reactive. Get all that automated and be able to look at the future and be able to look at growing your program, being able to look at driving more fee income, being able to provide that value to your originators, because the more proactive you are able to be as a financial institution, the better you're going to be able to help your originators.